reserve requirement, and expansionary monetary policy. As you can tell from the aggregate supply, aggregate demand graph, this economy is in a recession, that the current output is less than the full employment output at Y sub F. To speed up the economy, the Fed uses expansionary monetary policy. Let's say that the Fed uses the reserve ratio or the reserve requirement to get this economy back to full employment. What the Fed would do is it would lower the reserve requirement. If it lowers the reserve requirement, what do you think happens to aggregate demand? Nothing. Reserve requirement is not a component of aggregate demand. If the reserve requirement goes down, then the only thing that happens is excess reserves in the banking system go up. Now what happens to aggregate demand? And the answer is nothing. Excess reserves are not a component of aggregate demand. If the bank holds on to the reserves, nothing's going to happen to aggregate demand. If banks now lend these excess reserves, then what will happen is the money supply will increase. An increase in the money supply is a shift to the right. Notice that when the money supply shifts to the right, that the nominal interest rate goes down. As the nominal interest rates go down, real interest rates have a propensity to follow nominal interest rates. As nominal interest rates fall, then consumption goes up and investment goes up. And since consumption and investment are large components of aggregate demand, this will shift aggregate demand now to the right. So we're going to go ahead and shift aggregate demand to the right. As aggregate demand shifts to the right, watch what happens to the price level. The price level goes up. Notice that as aggregate demand shifts to the right, the price level goes up. Real GDP and national output also go up. Watch how Y sub C gets closer to Y sub F. Real GDP and national income go up. Employment also goes up. As more output is being produced, then employment goes up, which means then that unemployment goes down. Expansionary monetary policy using the reserve requirement could get the economy to move from a recessionary gap closer to, if not all the way to, full employment.